$9.2 trillion. That's the amount in U.S. Treasuries that will mature this year. It's about 30% of all outstanding U.S. debt. In early June, the Treasury completed its largest debt buyback in U.S. history, a whopping $10 billion. The purpose? To reduce borrowing costs and ensure fiscal sustainability. Investors are concerned about the bond market and U.S. national debt, but combined with the Trump administration's new tariffs, both global markets and the average citizen are paying closer attention. From Berlin to Tokyo, from Wall Street boardrooms to small-town diners, people are asking the same questions. How will the tariffs affect me? And can the U.S. manage its debt? So, how exactly are tariffs and debt connected? Let's start with the basics. The total federal debt now stands at $36 trillion. To fund it, the U.S. government borrows money by issuing bonds. Here's how that works. Investors lend money to the government by buying bonds. In return, the government pays regular interest and returns the money when the bond ends. But bond prices rise or fall depending on investor confidence. If people worry about the government's ability to pay back loans, they buy fewer bonds, lowering the price. When bond prices drop, the interest rate increases. That means the government has to pay more to borrow money. U.S. bonds are usually very safe, but that trust weakened in April. After Trump announced he'd impose reciprocal tariffs, the U.S. stock market fell sharply. But the president was determined to push ahead with his tariff plan. The shakeup of global markets prompted investors to start dumping bonds, forcing interest rates to rise. On April the 8th, the U.S. government auctioned $58 billion worth of three-year bonds. But with investors skeptical, there weren't enough buyers. That meant U.S. banks had to purchase the remaining bonds.
Stocks surged this afternoon after President Trump announced a 90-day pause on
90-day pause on tariffs.
On April the 9th, Trump paused reciprocal tariffs for 90 days for most U.S. trading partners. But for many investors, the damage was already done, setting off a chain reaction. They were concerned that tariffs would increase U.S. inflation, raise the cost of living, and hurt both businesses and consumers. With a greater risk of a recession, investors want higher returns for lending money to the U.S. government. So bond prices dropped and interest rates rose. Higher inflation means the Federal Reserve could also keep interest rates high for longer. That makes bonds even less attractive, which means more selling. Even America's allies are concerned about the bond market and tariffs. Japan is the largest foreign holder of U.S. public government debt. But it may consider selling its U.S. Treasury bonds as leverage in tariff talks with Washington. Such a sale would have a profound impact on the price of bonds. Credit rating agencies are also concerned about the U.S. debt. In May, Moody's became the last of the three major agencies to downgrade the U.S. from its top AAA rating. This signals rising concern about U.S. government debt and the impact of tariffs. It also affects how much the government has to pay to borrow and impacts everyone who holds U.S. debt. So, who exactly holds that debt? Roughly 75% is held by U.S. investors, entities, agencies, the Federal Reserve, and even ordinary Americans. And it's Americans who will likely be affected first when the bond market is in trouble.
And if right now you are saying, why in the world do I care? Treasury bonds mean nothing to me. Well, higher interest rates for treasuries, especially the 10-year, well, that means you're going to pay more for a mortgage, a car loan, or a business loan. And your credit card debt just got more expensive.
The remaining 25%, still worth trillions, is held by foreign governments and investors. When they get nervous, the effects ripple across the globe. But it seems like the Trump administration is not concerned.
Well, first of all, Margaret, I will say the United States of America is never going to default. That is never going to happen. That we are on the warning track and we will never hit the wall.
The United States can pay any debt it has because we can always print money to do that.
They essentially print money and then they buy that. And then that has a consequence. That devalues money raises inflation and so on.
You are going to see a crack in the bond market, okay? It is going to happen.
The U.S. government says tariffs are meant to protect American industries. Instead, they rattled markets, affected bonds, and raised concerns over U.S. debt. When the world's most trusted borrower starts to look shaky, the whole world is affected, with the biggest impact on the U.S. itself.
We're operating at a fiscal deficit now that is unsustainable over a very long period of time. We don't know whether that means 2 years or 20 years, because there's never been a country like the United States. But you know that if something can't go on forever, it will end.